quarter of subtle shifts, not headline drama. DDMP REIT, Incorporated began 2026 with financial results that, while softer at first glance, reveal a story of resilience beneath. Total revenue landed at 471.5 million pesos, down just over 3% from a year ago. Net income also declined, but the core of the business told a steadier tale. Rental income, which anchors the REIT's value, rose almost 4% to 418.7 million pesos. This growth stemmed from higher rental rates and variable components that provided a cushion against external headwinds. Yet, the Philippine office market remains in transition. Occupancy stood at 59.67%, a number that speaks volumes about current challenges. Much of the portfolio's potential remains untapped, with the flagship Double Dragon Plaza contributing the lion's share of earnings. The company's ability to convert built assets into cash-generating leases is now more critical than ever. Expenses rose, pulled by rising administrative costs and property maintenance. Non-rental income, especially from other charges, fell sharply, weighing on overall profits. Still, the REIT's net income margin held firm, above 76%, supported by an effective zero tax rate. This buffer sustains profitability, even during periods of subdued top-line growth. Crucially, DDMP REIT remains debt-light, with just 1.55 billion pesos in liabilities against 63.4 billion in equity. This conservative balance sheet limits refinancing risk and preserves flexibility, a clear strength in a volatile market. Dividend payouts remain robust, but the most recent distribution exceeded quarterly distributable income. While not immediately alarming, it's a dynamic investors should continue to monitor as the funding environment and collections evolve. Receivables crept higher, signaling the importance of rent collection discipline amid ambitious payout commitments. For income-focused investors, the question remains whether recurring cash flow can consistently support high dividends over time. In summary, DDMP REIT's first quarter showcased steady rental gains and strong financial defenses. However, improving occupancy and collections will be key to unlocking the portfolio's full potential. The REIT's story, yield-rich, asset-backed, and conservatively managed, continues, but its next chapter depends on translating physical assets into sustainable, growing returns.